This eternal dance, from mania to panic, is not a random phenomenon but a direct reflection of unchanging human psychology. Many who venture into the speculative arena are perpetually searching for the next new thing, the groundbreaking strategy, or the secret indicator that will grant them an insurmountable edge. They chase fleeting trends and novel instruments, often ignoring the profound and repetitive patterns that have dictated market behavior for centuries. What they fail to grasp is that while technology and specific assets may evolve, the fundamental emotional drivers of market participants remain constant. Greed, fear, hope, and pride are the timeless forces that propel prices to unsustainable heights and then plunge them into the depths of despair. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Jesse Livermore, one of the greatest speculators in history, understood this immutable truth perhaps better than anyone. His tumultuous career, marked by multiple immense fortunes made and lost, was a testament to his uncanny ability to decipher the market's psychological pulse. He meticulously observed how collective human behavior dictated price movements, recognizing that the market itself was merely a mirror reflecting the prevailing emotions of its participants. His insights were not derived from complex algorithms, but from a profound understanding of human nature's predictable irrationality. Livermore's teachings underscore that the market, in essence, is a narrative woven by collective sentiment. This narrative, however, is not a story of continuous progress or unending decline. It is a recurring saga of euphoria giving way to anxiety, and anxiety giving way to fear, culminating in panic, before the cycle quietly begins anew. To truly succeed in this arena, one must learn to detach from the emotional ebb and flow, to see the market's movements through a lens of objective realism, rather than being swept along by the crowd's fleeting moods. Therefore, this exploration will delve into Livermore's timeless understanding of the market's cyclical nature, specifically focusing on the transition from mania to panic. By recognizing the distinct psychological and price action characteristics of each phase, a disciplined speculator can position themselves to profit from these recurring patterns, rather than becoming a victim of the crowd's predictable emotional swings. Understanding this perpetual cycle is not merely a historical curiosity, it is a vital key to long-term survival and prosperity in any market. The cycle inevitably begins with the mania phase, a period characterized by widespread euphoria and an intoxicating illusion of easy wealth. As prices steadily climb, initially driven by sound fundamentals, optimism gradually transforms into irrational exuberance. Early participants, who enjoyed significant gains, become bolder, and their stories of effortless profits attract an ever-increasing stream of new entrants into the market. This creates a powerful self-reinforcing loop where rising prices beget more buyers, and more buyers push prices even higher, seemingly validating the pervasive belief that this time it's different. During this phase, critical thinking and prudent risk assessment often dissipate. News headlines are overwhelmingly positive, focusing exclusively on success stories and future projections that seem boundless. Media outlets amplify the pervasive optimism, celebrating new expert voices who emerge to confidently predict ever-increasing gains, often with little historical context or genuine experience. This creates a powerful fear of missing out, FOMO, culture, compelling even cautious individuals to abandon their reservations and jump into the market, lest they miss out on the seemingly effortless profits everyone else is enjoying. Jesse Livermore keenly observed that at the peak of such manias, the public is fully invested, often leveraging their positions heavily with borrowed money. Caution is replaced by recklessness, and the pursuit of quick riches overshadows any consideration of fundamental value or inherent risk. Even obvious red flags, such as skyrocketing valuations or a disconnection from underlying economic realities, are dismissed as relics of an outdated mindset. The market becomes a giant speculative game, driven solely by the belief that prices will continue to rise indefinitely. It is precisely within this climate of widespread optimism and insatiable greed that the smart money begins its quiet exit. Professional operators, who accumulated shares during earlier, less enthusiastic phases of the market, use the surging demand from the public to distribute their holdings. They sell into the euphoria, capitalizing on the crowd's insatiable appetite, often at prices far exceeding intrinsic value. While the public is rushing in to buy, convinced of an unending bull market, the astute professional is systematically reducing their exposure, preparing for the inevitable shift. Therefore, the mania phase, while seemingly a period of effortless prosperity for the many, is in reality a perilous trap for the uninformed. It is a time when emotion triumphs over logic, when caution is ridiculed, and when the seeds of the next downturn are silently sown. Understanding the intoxicating nature of euphoria and its pervasive blindness is the first critical step in avoiding its devastating consequences. preparing oneself for the inevitable transition that follows this period of collective delusion. Following the peak of the mania, the market inevitably enters a transition period, marked by the subtle, yet discernible, onset of doubt and initial corrections. This phase is particularly treacherous because the prevailing euphoria hasn't fully dissipated, and many cling to the hope that any dips are merely temporary buy-the-dip opportunities within a still strong bull market. Jesse Livermore understood that this period is when the market ceases to act right, signaling a fundamental shift in its underlying character, often masked by superficial resilience. In this phase, prices may still attempt to push to new highs, but these advances become increasingly narrow, lacking conviction, and are often met with swift retreats. The market exhibits increased volatility, with larger swings in both directions, yet fails to make significant net progress. What appears to be strength is, in fact, exhaustion. Livermore noted that a stock might open strong, attempt to rally, and then close near its low for the day, or even below its opening price, despite seemingly good news. This indicated that sellers were beginning to overpower buyers at elevated levels. Crucially, in this transition, the destructive emotion of hope becomes paramount for many participants. Traders who bought near the peak, now seeing their profits diminish or turn into losses, cling to the hope that the market will quickly rebound. They refuse to cut losses, rationalize every dip as a temporary setback, and perhaps even average down on their losing positions, believing a full recovery is imminent. This emotional attachment to an increasingly flawed thesis blinds them to the escalating risk and prevents them from exiting at manageable losses. During this period, the smart money continues its methodical distribution. While the retail investor is still buying on dips, interpreting them as buying opportunities, larger institutions and seasoned professionals are quietly selling into any rallies. The volume might remain high, but its distribution volume meaning that strong buying is being met with equally strong selling, preventing sustained upward progress. This subtle interplay of price and volume signals the underlying shift in supply and demand dynamics, indicating that sellers are gaining control. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Therefore, the transition period is a critical juncture that demands astute observation and a profound detachment from emotional biases. It is the phase where the market reveals its true intentions to those willing to listen to its language of price action and volume, rather than the comforting whispers of hope and optimism. Recognizing these early signs of faltering momentum and a change in market character is essential for positioning oneself defensively, avoiding the full brunt of the subsequent and inevitable decline into panic. Following the deceptive calm of the transition period, the market inevitably plunges into the terrifying panic phase, characterized by pervasive fear and mass selling. This is the stage of outright capitulation, where hope completely dissipates, and individuals are overcome by an overwhelming urge to sell everything, regardless of value, simply to escape the agonizing pain of mounting losses. Jesse Livermore meticulously documented how this phase is marked by a complete breakdown of rational thought, as primal fear grips the collective consciousness, leading to a relentless and indiscriminate liquidation of assets. As the market accelerates its descent, the losses become unbearable for many. Margin calls, the demand for additional collateral from brokers, become widespread, forcing leveraged investors to liquidate positions, regardless of their desire to hold. This forced selling exacerbates the decline, creating a vicious cycle where falling prices trigger more margin calls, leading to more selling, and further price drops. The speed and intensity of this downward spiral are often shocking, overwhelming even experienced participants and instilling a sense of hopelessness that blankets the entire market. In this phase of capitulation, any remaining vestiges of optimism vanish. The media, which once fueled the mania, now sensationalizes the collapse, broadcasting dire warnings and stories of financial ruin. The new experts who preached endless gains either disappear or frantically pivot to predicting further Armageddon. The pervasive sentiment is one of utter despair, a belief that the market will never recover, that all investments were a mistake, and that the only remaining option is to sell immediately, regardless of the price, to prevent total ruin. Livermore recognized that the bottom of the market cycle, the point of maximum opportunity, occurs precisely during this period of extreme panic and despair. While the masses are selling in a frenzy, cutting their losses at the absolute lowest prices, the truly astute smart money quietly begins to accumulate. They buy when blood is in the streets, when others are too terrified to even consider purchasing. This contrarian action, buying when everyone else is selling, demands immense courage and a profound understanding of the market's cyclical nature. Therefore, the panic phase is the market's ultimate test of emotional fortitude and disciplined foresight. It is a period of widespread pain and financial destruction for the many, Yet it simultaneously presents the most lucrative opportunities for the few who can remain objective and act against the prevailing terror. Understanding the dynamics of mass fear and capitulation is essential for recognizing the ultimate low, positioning oneself not to be a victim of the panic, but a beneficiary of the inevitable, quiet accumulation that follows. The profound observations of Jesse Livermore underscore a timeless truth. The market swings from mania to panic are not historical anomalies, but eternal cycles rooted in unchanging human nature. He famously declared that Wall Street never changes. The pockets change, the suckers change, the stocks change, but Wall Street never changes, because human nature never changes. This enduring reality implies that the fundamental psychological forces driving prices to extremes will continue to manifest, regardless of the specific assets being traded or the technological advancements facilitating transactions. The master speculator, therefore, understands that true success lies in recognizing and leveraging these predictable patterns, rather than becoming a perennial victim of the crowd's emotional excesses. Livermore's greatest lesson, distilled through immense personal triumph and devastating failure, was the absolute necessity of mastering one's own emotions. Fear, greed, hope, and pride are not just abstract concepts, they are powerful, tangible forces that can hijack rational thought and compel even the most intelligent individuals to make ruinous decisions. The market, in its cold indifference, does not care about your hopes or your fears. It simply moves according to the collective forces of supply and demand, often driven by the very emotions that blind individual participants. The speculator who can detach from these primal urges gains an unparalleled advantage. To truly profit from these eternal cycles, one must adopt a disciplined, often contrarian, approach. While the crowd is engulfed in euphoria during the mania phase, buying recklessly, the astute speculator is quietly distributing their holdings, selling into strength. Conversely, when panic grips the market, forcing indiscriminate selling, the disciplined professional begins to accumulate, buying when others are too terrified to even consider purchasing. This ability to act against the prevailing sentiment, to maintain objectivity when others are consumed by emotion, is the hallmark of genuine market mastery. This mastery extends to having a clear, predetermined plan for every trade. Livermore emphasized the importance of setting stop losses before entering a position, ruthlessly cutting losses when a trade moves against you. He equally stressed the need to let profits run, resisting the urge to take small gains prematurely when a major trend is underway. These disciplined rules, applied with unwavering consistency, act as a powerful antidote to the emotional impulses that lead the majority to financial ruin. They provide a logical framework that shields the speculator from the irrationality of the crowd. Therefore, the enduring lessons of Jesse Livermore are a powerful reminder that while the face of the market may change, its heart, driven by human nature, remains constant. Those who learn to control their emotions, to recognize the predictable patterns of mania and panic, and to act with unwavering discipline will find themselves consistently on the profitable side of the market's eternal cycles. This is not about predicting the unpredictable, but about understanding the unchanging, allowing one to ride the waves of market psychology to enduring success. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.